In 2026, if you are wealthy in America, you can buy a $500,000 home with a 3% down payment assistance program, lock in a fixed mortgage at 6.8%, build equity every month, and deduct the mortgage interest from your federal taxes. If you are poor in America, you pay $1,400 a month in rent. You build zero equity, you get no tax deduction, and your landlord raises the rent 8% every year. Same city, same neighborhood in some cases, radically different financial outcome. Not because of different decisions, but because of different starting points. That is the visible version of the hidden tax, but it goes much deeper than housing. In America in 2026, poverty is not just a condition, it is a billing system. A carefully constructed network of fees, rates, penalties, and pricing structures that extract maximum money from the people who have the least of it, and that operate so quietly, so normally, so embedded in the daily mechanics of low-income life that most people never recognize them as a system at all.
They just know that everything costs more than it should, that the math never quite works out, that they work full-time and fall further behind every month. That something is wrong, but nobody has ever named exactly what. This video names it. The hidden tax on being poor in America is real. It is documented, it is measurable, and for the approximately 38 million Americans living below the poverty line and the additional 90 million living in financial fragility just above it, it extracts thousands of dollars annually from households that can least afford to lose them. The data in this video draws from the Consumer Financial Protection Bureau 2025 research, the Brookings Institution Poverty Premium Analysis, the National Consumer Law Center Predatory Lending Research, the Urban Institute Housing Cost Studies, the USDA Food Access Research, the Federal Reserve Survey of Consumer Finances 2023, the Center for Responsible Lending Payday Loan Data, and the Pew Charitable Trust's Financial Security Research. These are nonpartisan institutions documenting what the financial system actually costs people at different income levels, not what it is supposed to cost them.
Hidden Tax 1. Banking while poor. If you have money in America, the banking system pays you to keep it there. High-yield savings accounts currently offer 4.5 to 5% annually. Checking accounts at major banks offer free services, fraud protection, and mobile deposits. The system rewards account holders. If you do not have enough money, the same banking system charges you for the privilege of being poor. The average overdraft fee at major American banks is $35 per transaction in 2026, according to the Consumer Financial Protection Bureau. A low-income worker whose $800 paycheck clears 2 days late or whose automatic bill payment hits 1 day early pays $35 for a transaction that costs the bank approximately 30 cents to process. That is an 11,567% markup on the cost of the service. The CFPB found that overdraft fees are overwhelmingly concentrated among low-income account holders. The bottom 18% of bank customers by account balance pay approximately 91% of all overdraft fees. These households, the ones with the least financial cushion, are being systematically charged the most for the mistakes that financial fragility makes inevitable. For the approximately 5.9 million American households that are entirely unbanked, no checking account, no savings account, no banking relationship, the costs are even higher. Check cashing services charge 1% to 3% of the check's face value for the service of converting a paycheck to cash. On a $1,000 paycheck, that is $10 to $30 per pay period. Annually, that is $260 to $780, paid simply for not having a bank account. Money orders, the mechanism unbanked households use to pay bills that require a check, cost $1 to $5 each. A low-income household paying rent, utilities, and insurance by money order might purchase 4 to 6 monthly. Annual cost, $48 to $360 for the privilege of paying bills without a checking account. The Federal Reserve estimates that unbanked and underbanked Americans spend approximately $40 billion annually on alternative financial services, check cashing, money orders, prepaid debit cards, for basic banking functions that cost account holders at mainstream banks nothing.
Hidden Tax 2. The cost of credit while poor. In America, the less money you have, the more you pay to borrow it. This is so normalized, it has stopped registering as the extraordinary injustice it represents. A wealthy American with a credit score above 750 borrows money for a car at 4 to 5% interest. A low-income American with a credit score below 580 borrows money for the same car at 15 to 24% interest.
On a $15,000 car loan over 5 years, the wealthy borrower pays approximately $1,975 in total interest. The low-income borrower pays approximately $10,400. Same car, same loan term, $8,425 more, extracted purely on the basis of financial history that correlates almost perfectly with income level. The credit card premium is even more extreme. The average interest rate on credit cards held by low-income Americans, those earning under $35,000 annually, is approximately 28% to 30%, according to the Consumer Financial Protection Bureau. The average rate for high-income cardholders is approximately 18 to 20%. Lower-income households pay 8 to 10 percentage points more annually to carry balances they accumulate precisely because their income does not cover their expenses. On a $3,000 credit card balance, modest by American standards, the difference between 19% and 29% interest is approximately $300 annually. Over 5 years of carrying that balance, it is $1,500, extracted from the household that could least afford it. Payday loans represent the apex of the poverty premium credit system. The Center for Responsible Lending documents that payday loans carry effective annual percentage rates of 300% to 400% on average. A $300 payday loan repaid over 2 weeks costs approximately $345 to $390. Annualized, that is an APR of 390%. The typical payday loan borrower takes out 8 loans per year, not because they are financially irresponsible, but because the 2-week repayment cycle is incompatible with the monthly expense cycles they are trying to bridge. The payday loan industry collected approximately $9 billion in fees from American borrowers in 2025, according to the Pew Charitable Trusts. 90% of those fees came from borrowers who took out 5 or more loans annually. The business model depends not on occasional use, but on the debt trap that the loan structure itself creates.
Hidden Tax 3. The Food Desert Premium. The USDA defines a food desert as a low-income census tract where a significant portion of residents have low access to a supermarket or large grocery store. Approximately 19 million Americans live in food deserts in 2026. In food deserts, the available food purchasing options are convenience stores, dollar stores, and fast food restaurants. The price premium for equivalent food items at convenience stores versus supermarkets averages 20% to 40%, according to USDA research. A gallon of milk that costs $3.80 at a supermarket costs $5.20 at a convenience store. A loaf of bread that costs $2.50 at a grocery store costs $3.80 at a corner store. For a family spending $400 monthly on food, the approximate average for a low-income family of 4, a 30% convenience store premium adds $120 monthly. That is $1,440 annually spent not on better food, but on worse food at higher prices, simply because the affordable option is not geographically accessible.
The transportation cost compounds the problem. Low-income households in food deserts who do have access to a vehicle or who can afford a bus or rideshare must travel further to access affordable groceries. The time cost, the transportation cost, and the bulk purchasing limitations of households without cars or storage space all push effective food costs higher. The nutritional consequence, higher rates of diet-related illness in low-income communities, creates its own financial cascade. Diabetes, hypertension, and obesity, conditions strongly correlated with food insecurity and food desert residents, generate healthcare costs that further strain already depleted household budgets.
Hidden Tax 4. Insurance while poor. Auto insurance premiums in America are set using factors that have nothing to do with driving behavior and everything to do with financial status. Credit score is one of the primary factors used by auto insurers in 43 states to set premium rates. A driver with a poor credit score, which correlates strongly with low income, pays approximately 97% more for auto insurance than an identical driver with excellent credit, according to the Consumer Federation of America. Same driving record, same vehicle, same coverage. Double the premium. On an average annual auto insurance premium of $1,600, the credit score premium adds approximately $1,550 annually. For a low-income household already stretched to the breaking point, that $1,550 is not an abstraction. It is the grocery budget. It is the utility bill. It is the difference between making rent and not making rent. Zip code pricing compounds the credit score premium. Insurers charge higher rates in zip codes with higher rates of uninsured drivers, which correlates strongly with lower-income neighborhoods.
Low-income drivers in low-income neighborhoods pay higher premiums, partly because their neighbors cannot afford insurance, a circular penalty that ensures the cost falls heaviest on those least able to absorb it. Homeowners insurance follows a similar pattern. Low-income homeowners, more likely to own older homes in higher-risk areas, pay disproportionately higher premiums for properties worth less. The insurance cost as a percentage of property value is significantly higher for low-income homeowners than for wealthy ones. The uninsured penalty for those who cannot afford coverage is the most severe consequence of all. A single at-fault accident without insurance can trigger license suspension, vehicle impoundment, lawsuit liability, and a financial judgment that follows the uninsured driver for years. The penalty for not being able to afford insurance is a debt and legal burden that makes affording insurance in the future even more difficult.
Hidden Tax 5, the rental premium. The wealth-building mechanism that previous generations used to enter the middle class, homeownership, has become inaccessible to low-income Americans at precisely the moment when renting has become most expensive. The Urban Institute documents that renters in America pay an effective housing cost premium of 15 to 40% compared to homeowners with equivalent monthly payments, because renters build zero equity while homeowners build equity with every mortgage payment. A homeowner paying $1,400 monthly is purchasing an asset. A renter paying $1,400 monthly is purchasing the right to occupy the asset for another month. Over 10 years of equivalent monthly payments, the homeowner has built approximately $80,000 to $120,000 in equity through principal paydown alone, before appreciation. The renter has built zero. The wealth gap between renters and owners compounds continuously, and it falls almost perfectly along income lines. The security deposit system represents an additional hidden tax on low-income renters specifically. A standard security deposit of 1 to 2 months' rent, $1,400 to $2,800 on an average unit, must be paid up front before occupancy. For a low-income household, this deposit is not a routine financial transaction. It is a crisis. It forces borrowing, depletes emergency funds, or prevents access to housing entirely, pushing households toward more expensive weekly rental arrangements or overcrowded shared housing that carries its own financial and physical costs. The eviction premium is the most severe consequence of the rental system for low-income households. An eviction record, even an eviction that was successfully contested, appears on tenant screening reports for 7 years and effectively bars the evicted household from most formal rental housing. The consequence of a single financial emergency that causes a missed rent payment can be permanent exclusion from stable housing, forcing households into the most expensive and least stable segments of the rental market indefinitely. Hidden Tax 6, the convenience premium. Wealthy Americans buy in bulk. They purchase annual subscriptions at discounted rates. They buy quality items that last years rather than cheap items that require frequent replacement. They have the storage space, the upfront capital, and the financial stability to optimize purchasing decisions for long-term cost efficiency. Low-income Americans buy small. They purchase the smallest available package because the larger one requires more upfront cash than the budget allows. They pay per-unit prices that are 20 to 50% higher than bulk rates for identical products. A 64-load container of laundry detergent at a warehouse store costs approximately $13, about 20 cents per load. The same brand in a 32-load container at a convenience store costs approximately $10, about 31 cents per load. The low-income household buying small pays 55% more per load, not because they chose to pay more, but because $13 up front exceeds the available cash.
This pattern repeats across virtually every consumer category. Smaller package sizes, pay-as-you-go phone plans versus annual contracts, monthly software subscriptions versus annual payments, weekly room rentals versus monthly leases. In every case, the option available to households with less upfront capital costs more per unit than the option available to households with more. The Brookings Institution estimates that the total annual poverty premium, the additional amount low-income households pay for equivalent goods and services compared to higher-income households, ranges from $500 to $3,000 annually, depending on household size, location, and specific circumstances. For a household earning $30,000 annually, a $2,000 poverty premium represents 6.7% of gross income, extracted not by taxes, but by the structure of prices that assume financial stability to access efficiency.
The hidden tax on being poor is structural. It cannot be solved by individual financial discipline alone. The system is designed to extract from people regardless of their choices within it, but understanding the extraction is the first step toward minimizing it.
The banking escape. Credit unions, nonprofit financial cooperatives owned by their members, offer checking and savings accounts with significantly lower fees than commercial banks. The National Credit Union Administration reports that credit unions charge overdraft fees averaging $25 versus $35 at commercial banks and offer free checking accounts at higher rates. The CFPB's Bank On program has certified accounts at multiple financial institutions with no overdraft fees and no minimum balance requirements. The unbanked premium disappears the moment a qualifying account is opened.
The credit escape. Secured credit cards, backed by a cash deposit that serves as the credit limit, allow individuals with no credit history or damaged credit to begin building a credit score without risk to the issuer. A secured card used for small, regular purchases and paid in full monthly generates positive payment history that raises credit scores within 6 to 12 months. A higher credit score reduces interest rates on every subsequent borrowing need: auto loans, personal loans, eventually mortgages. The compounding benefit of a higher credit score over a decade is tens of thousands of dollars in reduced interest costs. The food desert escape. Community-supported agriculture programs, CSA boxes delivered directly from local farms, provide fresh produce at prices competitive with or below supermarket costs. SNAP benefits are accepted at most farmers markets in 2026. Dollar stores, often criticized for food quality, have expanded fresh produce sections in recent years and can provide competitive pricing on staples when the alternative is a convenience store. Food banks and community pantries supplement grocery budgets without stigma. The majority of food bank users in America are employed. The insurance escape. Shopping auto insurance annually, not at renewal, but proactively, captures rate competition that insurers do not volunteer. Telematics programs offered by most major insurers track actual driving behavior and can override credit score pricing for demonstrably safe drivers. State insurance commissioners in several states have proposed or enacted restrictions on credit-based insurance pricing. Checking your state's current rules may reveal protections you were entitled to use. The rental escape. The path from renting to owning runs through credit score improvement, down payment accumulation, and program awareness. HUD-approved housing counseling is free. Down payment assistance programs exist in every state, many providing $5,000 to $25,000 in grants or forgivable loans to first-time buyers meeting income requirements. The Federal Housing Administration insures mortgages with down payments as low as 3.5% for borrowers with credit scores above 580. The gap between renting and owning is real. It is also smaller than most low-income households believe, primarily because the programs designed to bridge it are chronically underutilized due to lack of awareness. The hidden tax on being poor in America does not appear on any tax return. It is not collected by any government agency. It generates no revenue for any public purpose. It is collected by banks charging $35 for a 30-cent transaction, by payday lenders charging 390% APR on a $300 loan, by insurance companies charging double premiums for identical coverage based on a credit score, by convenience stores charging 40% more for the same milk, by a rental system that extracts monthly payments while building zero equity for the payer. It is collected quietly, automatically, from the Americans least positioned to resist it and most harmed by it. The Brookings Institution estimates that if low-income Americans paid the same effective rates for financial services, credit, insurance, and essential goods as middle-income Americans, the savings would be equivalent to a 15 to 20% income increase for households at the poverty line, not from a raise, not from a government program, simply from paying what everyone else pays for the same things. That gap between what poverty costs and what financial stability costs is the hidden tax. It is real. It is measurable. And for the 130 million Americans living in poverty or financial fragility in 2026, it is the reason the math never adds up, no matter how carefully they try to make it work. It is not a math problem. It was never a math problem. It is a system problem. And systems can be navigated once you understand exactly how they work against you. Now you understand. This channel exists to name the systems most financial content never discusses directly. If that matters to you, subscribe. The information is free. The hidden tax is not.